Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
David Samra has been in the investment business for over 30 years. He specialises in international value and at the end of 2024 had beaten the index by over 4% per annum for over 20 years, in a period when traditional value has been doing badly. That may be why his fund, which has been closed to new investors for almost all of the last 14 years, has reached $50 billion. The reason is of course skill, but also what David terms cumulative knowledge build-up and his focus on four key factors: owning good companies, buying them at a discount of at least 30% to intrinsic value, and ensuring they have excellent management and a strong balance sheet. Samra will own stocks for several years. He's owned Arch Capital, one of his largest holdings, for over 20 years, and another, ABB, for over 10 years. In our discussion, he explains why, the issues of managing a $50 billion fund, which both restricts his universe and means he has to be absolutely sure when he pulls the trigger on a new stock, because he's committing $1 billion in capital and sometimes $2 billion or even more. Why he has been holding positions which he no longer sees as cheap, and why the business is much tougher today. He also explains what he does when management aren't protecting his clients' interests. David isn't scared to be an active investor. This is a fascinating discussion, especially when David started discussing some of his positions. His depth of knowledge is really impressive. I'm sure you'll enjoy this conversation with someone who must be one of the world's top value investors. David Samra, I'm really delighted to talk to you. I've spent the weekend reading your letters and it's really fascinating, and you've had an amazing career. I always start by asking people, did you always want to be a value investor? And I know you didn't until you took a class at university, and at Columbia you actually spent one day a week working with Mario Gabelli. So talk a little bit about how you found value investing and what was it like to work for Mario Gabelli, because he's been a guest on this podcast and he's a man that doesn't stand much nonsense.
He certainly doesn't. There are certain people, Stephen, who are wired for value investing. Most people prefer to be involved with particulars that ring as success. We want to be involved with NVIDIA because NVIDIA is doing very well right now, or we want to be involved with Costco because Costco is a great business. And it is a great business, and it takes a certain type of personality. As I've used this phrase, of course, it's a very common phrase, but it takes a certain personality to run towards a fire. And we love stock charts that go down. Those are the types of people that work in our organization. It's fascinating to me. I spend almost no time with the sell side. And the reason is, and I learned this very early on in my career, is, you tell the sell side what you do. Oh, we like companies that are out of favor and, they're undervalued. We take advantage of market psychoses. And you say, if you want to do business with us, great. Show us some ideas of companies that are out of favor, you have strong balance sheets. And every single phone call you get is, oh, our analyst upgraded this. The stock's already up 35%. And, the vast majority of market participants really are not wired in the same way that we are. And why I'm wired this way is beyond me. But the first experience that I had was in undergraduate school taking a security analysis class, and the industry that I was assigned to was pharmaceuticals. And so this is in the 80s, and pharmaceuticals were, sort of the technology companies of the era. And they were all highly valued. And my partner at the time chose Merck, which back then was a go-go growth stock. And I chose a company called A.H. Robbins. And A.H. Robbins was a company that had some serious litigation issues due to an IUD that had caused problems with some of their patients. But it also had some consumer products, one called Sudafed, which is an OTC pharmaceutical product here in the United States that was extremely valuable and well more valuable than the market cap had implied. Now, why I was attracted to that, I felt like I was getting something for nothing, right? Sort of a 2-for-1 deal. I grew up in a family, we didn't have any money, and we were always on the hunt for, a bargain, right? And this was, just innately attractive. And, over the course of our careers, over the course of my career, I collected people who thought or think in that same way. I've always been a value investor. I always will be, in the way that there's some sort of arbitrage that I'm getting. And over the years, I've been able to refine that arbitrage to include balancing out risk. And, risk presents itself in many different ways at the micro level. And we think a lot about that. So have I always wanted to be an investor? No. But as soon as I got to university, it really resonated with me. And I found a particular niche within investing that was very comfortable based on the way that I was brought up. Now, when I got to graduate school at Columbia, and there was really no other place to go, and I didn't apply to anywhere else because that's where Benjamin Graham taught, the father of value investing, and that's where Warren Buffett went to school. And when I got there, the first thing that I did is I took a job with Mario, because you could work there on Fridays, and this was your opportunity to get in the game, so to speak, and to learn from somebody that had a serious amount of experience. And, I would learn more in his Friday morning 45-minute research meetings than I would all week in my business school classes. So that was a very formative experience for me.
And what was Mario like to work for? Because he's a remarkable guy. I saw him in Omaha back in May, and he comes over and he shakes my hand and he says, "How are you doing? What's your best UK idea?" And I was thinking, Mario, it's Friday evening. Why don't you relax?
Yeah, no, there is, it's in you, right? And you can't help yourself. And, the desire to generate a return, which is a nice way to just make money, pervades, I think, most of the successful money managers that are out there. The first conversation they want to have is, what's your largest position? And that's neat. What was he like to work for? Oh, he was a tough cookie. And, one of my more formative experiences, and this, doesn't have to do with me, wanting or not wanting to be an investor, but sort of one of the experience tools that I picked up along the way was a situation that he was involved in where a division of a company that he was invested in was raided by the FAA, right? They repaired blades and vanes for aircraft engines. It was called Chromalloy. It was in upstate New York. I was, working with Mario in Rye, New York. And, Mario asked me to find out what was going on. And so I got on the phone and I called investor relations because I was a kid and I didn't know what I was doing. And I wrote down what the investor relations person said. And then I proceeded to walk into Mario's office and say, "Here's what's going on." Of course, he had read the press release, and he proceeded to throw me out of his office, and I'm putting that nicely, and told me to go back to my desk and really figure out what was going on. So, not knowing what to do, I had turned around to the fellow who worked in the cube behind me and asked him if I could borrow his car because, of course, I was a graduate student and didn't have any resources. And I drove up to upstate New York, wherever the factory was. This is in the day before Google Maps, right? So you had to figure out how to get there. And so I get up there and I'm in my suit and tie and I walk in, to the factory. And I said to the receptionist, may I please see the manager? I'm from Gabelli Asset Management. We're shareholders. And then she proceeded for the second time that day to throw me out of her office, saying, there's no way we're talking to you. So I go back to my car. I'm very frustrated. I don't know what to do. I'm afraid I'm going to get fired. So I see the coffee truck. There was a coffee truck outside the factory. And so I took off my tie, I rolled up my sleeves, I walked over and started chatting with the fellow who was running. I ordered a donut and a coffee. I started chatting. I'm like, wow, this must be really, really bad for you, having this factory shut down. And he said, yeah, it's been bad, but it's all over. And I said, what do you mean? He goes, oh, I heard today that the factory is reopening tomorrow. and so, I drove there's no cell phones, right? So I drove very quickly back to Rye, New York, and gave Mario that information. And, I don't know what he did with that information, but hopefully he used it to
Oh, I
make,
know.
hopefully he used it to make some money.
It's a brilliant story, and I really love that story because it's so different from today. And a young person, couldn't imagine doing that. I suspect.
Oh, well, I think that there's, different ways to do due diligence now, but that experience was formative for me. Like I said, it becomes a tool in your tool chest. So, for example, when I was hired out of graduate school into an international shop at a place that's now gone called Montgomery Asset Management, there was no training program. This was a startup, and they just put me in an office and said, make money. And I didn't know what I was doing. So what I did was I took Tweedy Brown, a very famous value investing shop in New York, who had started investing outside the United States. I just took their portfolio and I looked at all the companies that they owned. And I would go on these 2-week, 3-week, sometimes 5-week long business trips, just visiting company after company after company. Remember, there's no internet, right? These companies, they're not reporting their results in English, right? And some of them only report, some of them once a year, some twice a year. They don't report quarterly. You can't pick up the phone and call them, right? And so just going there and getting information put you at the leading edge of understanding what these businesses were doing. And so it was that formative experience with Mario that said, you got to get out there and you got to find the information that you need to figure out what's happening in these businesses so you can make an intelligent decision as to whether or not you want to own it. Who are the people that are running it? What are their goals and objectives? What are the strategies that they're using? And then analyzing their financials and details, which gets to your behind the balance sheet.
But this is still useful to do, though, isn't it? I find a lot of investors think you can just sit behind your desk and look at the numbers and look at the internet, and you can't really get a proper feel for the company unless you visit it, can you?
Well, I would say that if you ask many investors, you probably get a lot of different responses to that question. We believe relationships, understanding the people that are running the business, we believe it matters. What are their incentives? What are they trying to accomplish? What's their level of experience. Do they have the ability to handle the complexity of the business that they're managing, especially now. We manage $50 billion. Our universe has shrunk down to very, very large companies. And directionally, what happens to those businesses is very much in the hands of a few people. And knowing who those people are and what their experiences are and what their success rate is in driving forward a business. And given the facts that, as very large shareholders, we're investing $1 billion, $2 billion, sometimes $2.5 billion, maybe $3 billion in these businesses, we have the ability to put a very strong voice forward in terms of who's managing these companies, what are the incentives in place, and what we're looking for as owners, and that's the way that we think about who we are in investing in these businesses, that we are owners. And oftentimes we're owners for a longer period than the chairman or the CEO, who tend to, sort of come and go over time.
How typically, how long will you hold something for?
Well, we would love to, buy it today and then it revalues tomorrow and then we sell it and do it again. Unfortunately, value investing doesn't really work that way. Generally, when we get involved, there's some sort of issue that, has created a market psychosis. Oh, it's bad news and we don't want to own it. And there are challenges in this business. And it takes time for that market psychosis to go away until the company starts reporting more positive information than negative information. Sometimes, companies can continue to report positive information, but institutional memories are, institutions are the ones that move the price at the margin, right? It's not being driven generally by retail investors, especially these big companies that we own now. And it takes an institution a long time to sort of buy into the good news. These things don't happen overnight. So generally we end up, going in thinking we're going to be around here for 3, 4, 5 years. And if you look at our turnover numbers, they're sort of between 15 and 25% year to year.
And you've owned ABB for like 10 years, right?
Mm-hmm. Yeah, we've owned Arch Capital basically since 2004. And so, there are certain businesses, where the value just keeps compounding. And for whatever reason, it's in property casualty insurance company and a decent sized chunk of the business is reinsurance, right? Run out of Bermuda. And people underappreciate the quality of that business and tend to give it a low multiple, right? And so it persists at this attractive multiple despite, a couple decades worth of evidence that this is an extraordinary company run by extraordinary people, and yet it fails to garner a valuation that we would think it puts us at some sort of risk of a permanent loss of capital. So we just keep owning it and it keeps compounding.
And presumably the attraction of that is that you know it better over time. Because you talk about this cumulative knowledge build. Talk a little bit about why you think that's important. It gives you an advantage.
Yeah, it's really interesting. We're a little old fashioned in that, we allocate responsibility by region, and everybody's that operates within a certain region, very broad regions. If you cover Europe, you cover all of Europe. If you cover Asia, you cover all of Asia. And then within,
so you got how many analysts?
We have six analysts, and we have 3 different regions, and 2 people in each region. And they're generalists within that region. So imagine you're coming out of undergraduate school or graduate school, and you get a job working for the Artists International Value Fund, and you say, okay, what do I do now? And so you get your first project and it's a retailer. So you start figuring out what do retailers do and how do they work and why is inventory turnover so important. And then you figure that out. And then your next project is a cement company, right? And then your next project is a bank. And it takes a very long time to become knowledgeable enough for you to sort of go wherever value is showing up. But what it does do, Stephen, is it fails to create analysts, but is successful in creating investors, people who can think about risk reward on an absolute basis, which is the way that we think about it, rather than on a relative basis. So the example that I used to give many years ago when we were open and we were bringing in clients is, and nobody thinks about the tech bubble anymore, but during the go-go technology days in 1999, if you had an analyst devoted to software, they would be pitching you an 80 times earnings company because it was cheaper than all the other companies trading at 100 or 110 times earnings, right? Because, they want to, these are smart, motivated people and they want to do things. But if you've got somebody who's a generalist that has a wide berth and then has years and years and years of cumulative knowledge build, they can go where value exists out in the marketplace. And we help them with that, of course. It's a very collaborative process. The analyst doesn't operate in a vacuum. They work together with myself and my co-portfolio manager and in a very detailed way. And that way we help them, figure out quickly what is the information that we need and why that's important. And that's the learning process that goes on inside. And the way that I built that is Stephen, what we talked about earlier, is just going out on the road and visiting companies and getting to know different businesses and investing in them over time and watching what happens. What is very important to this business? What drives these businesses? And I try to take that knowledge and accelerate the research process for our team. Now, to answer your question, do we still go out and visit management? The answer is unquestionably yes. I call it grazing, where you're on the road for 2 weeks or 3 weeks every quarter, and you're flying somewhere in the world. You're spending a couple of weeks, and you're visiting companies that we own, companies that compete with companies that we own, customers of companies that we own. But you're also going to visit the burnt out, dirt cheap companies that are trading in that market. And perhaps even more importantly, you're going to visit companies that you would love to own, but they're just not at the right price. And you're doing some, grazing, due diligence. Who are the people that run this? What's making it tick? What makes this a great business? And you're recording that information. And we put preliminary valuations on businesses, make some initial assessment, and then we wait. And we wait until something happens. Doesn't happen to all the companies that we admire, but occasionally there's a hiccup or a problem. And then we can go in and finish our underwriting process and make a decision as to whether or not we're going to invest there. And so, yes, the answer is yes, we still do it. It's just become a narrower playing field because of the size of our capital base.
Well, I hope you're enjoying this episode. And if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. I mean, this is an issue, isn't it? I mean, it's an enormous fund, and you're quite concentrated. You've got 40 odd positions. So how narrow is your universe? I mean, there aren't, I don't know what your liquidity constraints are, but I mean, there can't be that many companies that you can invest in.
No, there aren't that many companies that we can invest in. And so our job is made increasingly difficult. Like I said, we've been closed. We've effectively been closed. Other than a brief period around COVID, we've been closed since 2011. So the vast majority of the capital, despite our offers continuously to our clients to take some money back, has been from compounding. So we're kind of stuck with it. And, you know, part of the reason why we have been successful, you know, when I sit down and I try to figure this out, is by continuing to build more and more tools in our tool chest. So while we don't talk about this very much anymore, a few years ago, we found ourselves a very large shareholder of a French food company called Danone. And the management team, the CEO, who was also chairman of what is a French national champion, was undermining the business. He had very lofty ESG objectives, and he was draining money put behind innovation and marketing, which is the lifeblood of a consumer company, and investing it in his ESG projects. And he was killing the company. And we had a choice, you know, do we try to get $1 billion out of this thing, which is time consuming, and then find another thing, right, which is time consuming, and then put the $1 billion back into another thing, which is time consuming? Or do we take some steps to solve this problem? And we, of course, you know, we dialed for dollars. We called all the activists that we knew, and they said, you know, you got to be kidding me. This is France. There's no way. We'll be thrown out. And Pepsi tried to take this, you know, many years ago. It was impossible. But we had some advantages. One, we're a long only manager with a very good reputation. So people, though they tried, especially the media loves to call people activists. If you are simply utilizing your rights as a minority shareholder, somehow that makes you an activist, right? These are legal rights, rules, and regulations, laws that are created by a government that give you, as a minority shareholder, certain rights. And somehow, if you go ahead and try to enforce those rights, you become an activist in the eyes of the media. So, you know, if you ever believe anything you read in the newspaper, you should stop, because, you know, there's so much bias and so much lack of expertise on the part of journalists, generally speaking. You know, they're clickbait. They're trying to get clickbait. But anyway, you know, we engaged in this, and we had several advantages, right? Because of our cumulative knowledge, because of our relationships. We knew people on the board. We knew people that used to run these businesses. There was a small activist called Bluebell that was involved, and we knew of Bluebell from other things that we were involved in. And so we could pull together all of these resources and understand what was happening get a good enough understanding of what was happening inside these businesses, and have strong enough contacts. And this is really important, Stephen, to have strong enough contacts that knew that we were credible long-term investors, where when we provided them with what we were seeing, the information that we were seeing, they saw it, they did due diligence on it, they believed it, and they saw that this iconic company was being ruined. And all of a sudden, we had people on our side, right? People that were inside this company and on the board. And we were able over time. So the first thing that we did is we separated chairman and CEO. So that person went to just a chairman's job, and then we decided very quickly that he needed to leave that role. We got him removed as the chairman. We supported somebody who was on the board that we knew was a value creator to become the next chairman, which he was then voted in by the board. And then over the course of the next couple of years, we replaced the entire board of directors. And now Danone is considered, it took a little while, right? We got a new CEO, they brought in new executives at the top, and now Danone is considered to be one of the fastest growing FMCG companies, in a tough environment. And the valuation, has appreciated along with the decent growth rates that they're putting up. And so that is, and now we know how to do that. That is another tool in our tool chest. Now, we don't go out of our way seeking companies that have problems at the top, but where we do have serious amounts of capital invested, and even if there's not a problem, let's say there's just mediocrity, we can get changes to the incentive comp, or we can, let's say it's one of the two, a few of the senior executives need to be changed. We can help implement that change, and that helps accelerate the process of value creation. So as an investor, cumulative knowledge build, tools in your tool chest, these are things that you learn along the way that become useful to you as an investor, as an owner of a business, to try and improve your lot and generate excess returns.
And you would call yourself an active investor and not an activist, because you're doing this behind closed doors, talking to the board of directors in private.
Yeah, I mean, I worked for this place called Harris Associates in Chicago for a little while, and Harris was founded by an entrepreneur who basically started a family office that turned into an asset management company. And the way that Harris thought about investing was, when you buy shares in a company, the way that you should think about it is as an owner that owns 100% of this business. What would you do with this business if you owned 100% of the company? And, I oftentimes ask CEOs this question. If you weren't a publicly traded company, how would you run it different? Right? And it's shocking. A lot of it has to do with, a perception that they have to meet some quarterly bogey. A lot of it has to do with the way incentives are structured, because they have to meet, annual objectives set by the board, right? And if they had an incentive that was based on long-term value creation, and that can be measured, right, they would not pay so much attention to the quarterly beat and raise, which is all garbage pushed by the broker dealers to generate commissions and activity. If they were not forced to focus on those sorts of things, then they would run the business in a different way. And so we actually own a fair number of companies that are controlled by families, and part of the attraction there is they run it because it's theirs, right? And it's as if they own 100% of the company. And when they invest, not all families, some families are terrible, right, at running businesses, and others are pretty good. But we generally line up philosophically with people who think about a company for what it is, right? Not for what the stock market would like it to be.
It's a really fascinating subject. I wrote a few months ago, and I've got a weekly newsletter on Substack, and I wrote about corporate longevity, and most people didn't like it that much. You get the feedback, but a couple of people that I respect, professional investors, email me and say, "Oh, that was a brilliant piece," So I've been doing some more exploration about longevity, and I've written about family-owned businesses before because they seem to be in general they seem to be better and interesting. I was listening to Rory Sutherland speak. I don't know if you're familiar with him. The British, he's a vice chair of Ogilvy, and he's a big expert in behavioral science. He was saying, look, there are four companies, three private, one public, formerly family owned, that won the big marketing awards. And why is it that the Guinness was the Diageo was the public company, obviously no longer family owned, but still got that sort of longevity, that long life. And he said, I've just got back from Texas, and is it Bucky's the service station?
Oh, Bucky's is
Yeah,
amazing.
and there was also HEB, a food store, family owned.
I don't know.
He just was listing all these that he respected from a marketing perspective. And he said, well, why is it that family owned businesses do so well? Because they focus on the customer. And he was criticizing accountants, because accountants are, if you listen to the finance people, you just run everything according to the numbers. And that's not what creates innovation. That's not what creates the growth. It's the marketing people create growth by innovation and finding new products. It amazes me that more people don't sort of think in this way. It's interesting. And you run towards problems, and I just wondered how you did this, because my experience, the profits warning, the first one isn't usually the time to buy. Now, obviously, you've got to buy a bit on the way down, but just talk about how you gauge that now's the time, because you can't wait until it's turning round. Because if you're putting that amount of money to work, you've got to be very early, right?
Well, it's. I know this is not going to please people who love complexity, but the value of the business is the present value of the future cash flows, and we know most of these companies pretty well, given how long we've been doing it and how much time we spend analyzing them, and we have a pretty good idea what the earnings power of the business is, especially after we go through a detailed underwriting process. And if the price that we're buying, despite where it is in its problem process, if the price that we're buying at gives us our hurdle rates, right? So we shoot for 20% per year gross IRRs, and I say gross because that's not net of fees; it's net of mistakes, because we make mistakes. But if it meets our 20% IRR hurdle, then timing be damned, because it doesn't matter. And part of the refinement here, Stephen, is we're looking for businesses. We're not looking for any old business that's cheap, right? You can get that. You can buy an EFA value index and get statistically cheap equities and pay almost nothing for it. We're looking for good businesses that are undervalued.
But everyone's doing that.
Sorry?
That's what everyone's doing.
Everyone should be doing that.
But why have you been so successful at it?
Well, we do it. Everyone says they're doing it, but if you look at their portfolios and you say, "What, is that really a good business? Really?" Beauty's in the eye of the beholder, and people, marketing is really important to raise money. Remember, I've been closed since 2011. I almost run this like a family business, right? I can think long term about, if I lose some clients here and there because they're upset that the market's gone up and we haven't participated, it's okay. And because we're here to generate absolute returns and not take an enormous amount of risk in that process. But getting back to the timing, if we're buying a good business, there is some underlying value growth every year. So if it's taking 2, 3, 4 years before it revalues, as long as the underlying value of the business is growing, I'm protecting myself against inflation eroding away my purchasing power. So it doesn't bother me. The timing doesn't bother me in the least. In fact, Stephen, it generally works in our favor because we're so early that usually there's more bad news that comes out and the share price goes down, and it gives us an opportunity to average down and get it at an even more attractive price. As long as, our estimate of normalized earnings power doesn't change.
So you buy something, it goes down, you buy more, you presumably at some point you retest your hypothesis because, continuously. Because I interviewed Bill Nygren from Harris, your former employer. I don't know, did you work with Bill at all, or was it only with David?
Bill was on the domestic side, and I worked for David Harrow on the non-US side.
They had this sort of very interesting thing where they called it a mistake management protocol. So they buy something, it goes down, it carries on going down. He said, well, at some point, the analyst loses his voice because the stock market's telling you one thing, and you're assuming that's going to reverse, and so they swapped analysts. Well, just talk us through. You've bought something, it's gone down 20%. You bought some more on the way down. There must come a point where you start to think, oh, hang on, have we missed anything?
Well, so I don't know if you can internalize this, but I learned some things from Mario. Working for me is not a lonely job. You don't, the analyst doesn't lose voice. I lose money, right? And so, because we work collaboratively, right? We're looking at the same information, and this is my responsibility in the end. So I'm losing credibility. I'm losing money, and it's like a constant barrage of me looking over the shoulder of the analyst saying, have we checked this? Have we done this? Have we looked at this? What are we missing? Here's some other information I received from another investor who called me up and told me I was a moron. Have we looked at this? And so it's this constant re-underwriting process that helps us build more and more awareness of what's happening inside these businesses. I used to say, I don't say this much anymore, but owning a stock is a little like getting married. You don't really know your wife until, you've been living together for a while. And you come across stress points, right? Or big decisions that have to be made. And how everybody reacts to that, and what are the decisions made, and how good are those decisions. And companies are a little bit like that. And like I said, we have a gross IRR hurdle that's pretty high, knowing that, we're not going to always get it right, but we need to continuously reassess whether or not, we have this right thing. So our analyst doesn't lose voice, right? It's almost the opposite. It's like it all falls on me and the analyst working together to ask the right questions. So yeah, we used to do that in the international group at Harris. We would have another analyst. We called it the devil's advocate, right? It's basically a re-underwriting process. We don't do that in my group. We're constantly re-underwriting, right? And the devil's advocate is, in my view, and I'm not talking about Bill, but the way that our group was run at Harris was the CEO was far less involved in the details of the individual security. It was the analyst who did all the heavy lifting. Whereas in our group, the heavy lifting is done by the portfolio manager, which is me, and the analyst, and we do the work together.
And 20% IRR. Looking at your portfolio, ABB is a good company, right? But it's not cheap.
Well, not anymore, but it was when we bought it.
And you said in your letter in 2023, so beginning of 2024, you wrote that letter. You said it wasn't cheap then, and you still own it, and it's still like one of your biggest positions.
Well, I can't talk about what I've done this year, but what we did, if you look at our shareholder letter at the end of last year, and this is another, thing that is really important to me in communicating to my clients is, I laid out the top 10 securities, right, which is 45% of our invested assets, so they're meaningful. And I went through and talked about, what the return expectations look like for each one of those securities. And then I put, what our challenges would be in 2025, which was selling many of these securities and then finding, new investments that put us in a place to generate better expected returns. And so we have been doing that over the last, now 6 months. And, we measure a discount to intrinsic value every day. And we've widened that discount since the end of the year, but it's still not at a place where I can get really excited. And so, sometimes you have this acceleration in value realization, which has happened to us over the last 4 or 5 years, and you find yourself in a buoyant stock market with a portfolio of close to fairly valued securities. And then you have this big reinvestment process, which brings on reinvestment risk. You're buying all these companies where the news is bad, and you're buying a whole bunch of them at the same time. And that's a challenging process, but it is one that over the long term puts us in a position to generate better expected returns. And so, what we try to do is lay all that out for our shareholders so they understand exactly. Not everybody reads the letter, unfortunately, but and then they get frustrated, if they're suffering from reinvestment risk. But it's tough to communicate with $50 billion worth of shareholders.
Yeah, and also I suppose the issue is that it's hard for you to get in and out of stocks, and
Yes.
even if you're getting out of just one position, you might be replacing it with three because you might not have the same confidence, I guess. Just let's talk about some of your positions. I mean, your portfolio is very interesting. So one of the positions that I liked was Universal Music. Now, it slightly worries me that I own Universal Music, and so does Bill Eckman. But he's got a pretty good track record, and you own it as well. And what I don't understand, I've owned, when I was at the hedge fund, we owned Vivendi. I liked this business for a long, long time. And when I did the calculations, I said, mathematically, they make what Spotify makes. These are a big part of Spotify's earnings, and okay, they aren't selling concert tickets or selling podcasts or audiobooks or other stuff that Spotify is making, but they're valued at a fraction of Spotify. And I never understood that. Why do you think the market hasn't really sort of seen the value in Universal Music?
Well, so we got involved in the same way that you did through Vivendi, right? So this has been a multi-year return profile for us. And, it's in that camp of things that revalued. And now we're in the process of, trying to find other things to do with that money. And in that process, because we have a limitation, we can only hold 15% cash. When I get up towards 15%, I have to start making choices. Which of the securities I should sell and which of those I'll sell later, right? And I tend to sell later those securities that are higher quality businesses and better managed. And this company fits in that category. Now, it's a small position for us, for a few reasons. Why isn't it valued like Spotify? Well, Spotify is a technology company. And if you're a technology company, you get a higher multiple. That's just the way that it works. It doesn't mean that, and Spotify, quite frankly, is growing a lot more quickly and has a lot, maybe there's 3 meaningful music publishing companies in the world, right? You got Universal, you got Warner, and you got Sony. I don't know what happened to Bertelsmann. I can't remember. But anyway, they're growing maybe mid-single digit. They make or break music stars. Spotify is distribution platform. Think of it as television for music or television for podcasts, right? It's like a network. In the old days of go growth for networks in the U.S., ABC, CBS, and NBC, those things were very highly valued, and I think Spotify is sort of in that sweet spot right now, whereas the content creators, right? So Warner Studios, Paramount Studios, the studios, that created all the content that allowed that distribution to be so successful, they didn't carry valuations that were as high because they just weren't as popular. But I don't think Universal is undervalued in any way. Do you, Stephen?
Oh, you don't? Okay, I would, I would, I would be slightly more positive. I mean, it's got the valuation. I mean, the multiples
It
look
can
quite rich.
grow.
But
It can grow, and it does grow, and it's got the best management in the industry and the greatest lineup of artists. But there's no bad news that's keeping that company from trading at what is a pretty full valuation.
okay, how about Diageo? So Diageo, people keep telling me that young people don't drink, and I have a young son who drinks a lot. I mean, I appreciate that there are young people that don't drink, but I mean, I don't think alcoholic drinks are one of the oldest businesses in the world. I did this study of the longest life businesses a few months ago in my newsletter, and the most popular category was drinks companies. Drinks companies have been around for hundreds of years, and the idea, yeah, young people are more focused on fitness and maybe drinking a bit less. I don't think drinking a huge amount less. Um, you own Diageo. What?
Well, young people aren't going to use fossil fuels either, right? Um, I
Well, well, I think I'd be more likely to agree with you if you said young people won't use fossil fuels than I would that they won't drink.
Yeah, well, I'm being slightly pithy there. I do. There is certainly a slowdown in that business. Now there was a boom, a COVID boom, and now there's a slowdown. And the valuations of these liquor companies during COVID became very high. And if you just internalize that piece of information, right? Something that was clearly temporary, COVID, it was clearly temporary. You went back to the 1918 pandemic, you can see in 3 or 4 years it sort of washed itself out, right? It was clearly, easily identifiably temporary, yet valuations on these businesses went up. Fascinating insight in and of itself of the way the stock market works. You could buy Peloton at a huge multiple, right? An unproven business model at a huge multiple, yet they were giving us Ryanair in the middle of the pandemic, right? The best run airline in the world with the strongest balance sheet they were giving. And so now that situation has sort of reversed itself. And the pantry loading and the excess inventory that was held at bars and within the two-tier distribution structure that liquor companies operate with in the United States, a lot of that has sort of come back. And Diageo's made some mistakes, where they overloaded some of their distributors in certain parts of the world. You also have this GLP-1, which is real. It's growing very rapidly. The affordability of these products and the distribution of these products is only going to grow over time, right? As soon as one of these things goes generic, the penetration of these drugs is going to increase, and that curbs appetite for certain products, one of which is alcohol. And then you have this social trend that you alluded to, where younger people in social settings, some of them are drinking less. And I think that's more or less a U.S. phenomenon. I don't know that that's really translated outside the United States. So these companies are all facing, what look like some secular challenges. In the meantime, you have uh, a number of different publicly traded businesses that operate in this field that have different characteristics. And the one thing that we like about Diageo is not only do we think the valuation is attractive, but its scale and the quality of its brands, the scale at which they operate, and the power that they have within the distribution structure in the United States gives them very large competitive advantages. Now, these are micro observations, right? And so they're not particularly useful, but let me here where I live right now, I live here temporarily during the summer, where restaurants are very seasonal, right? And you go to a restaurant and you ask, I would like to have a rye Manhattan, for example, right? They have one rye. All the restaurants, one rye, and it's Bullet, right? It's a Diageo product. And what's happening, what I think is happening, if you understand the way retailers work and distribution works, is look, I'm cleaning the inventory off the shelf, but in order for me to have a broad line of attractive brand name, recognizable brand name products that will turn, I want to have, these brands. And when my distributor shows up, because Diageo many years ago moved more towards exclusive distribution within the system. When the big Diageo distributor shows up, they say, you need to carry these products. And by the way, we're putting, marketing behind these products. And by the way, when you're mixing your non-alcoholic, mojito, here's our new product in that category. In order for you to continue to carry Bullet Rye, we would like you to carry this, please, Mr. Bartender and Mr. Liquor Store Operator, right? So they, it does come down to execution. They have to execute on this. But the distribution strength, which is real for this company, sets them apart. It's not only distribution, but it's also marketing support, innovation behind the products to try to, create new cocktails and new events for people to, want to drink, puts them in an ability to perhaps gain market share in a difficult environment like this. And we like companies like that. And that's what we mean by good business. You can look at the numbers, right? You can get, quote unquote, behind the balance sheet, in this case, mainly income statement. And you can see, that this is probably the most profitable FMCG company in the world. It is, by the numbers, a fantastic business. But if you start to peel back the onion and look at where are the competitive advantages, where do they come from, and how are they reflected inside this company, you can see that in a more difficult environment that they should be able to continue to grow the underlying value of this business.
I mean, management, we've touched on, it's obviously very important if you're going into companies that have got a problem, got something, happening, something that's bad. And I just wondered if you could talk a little bit about how you judge management. Obviously, you've mentioned in incentive structures, and you described George Weston of AB Foods as truly wondrous. And I wondered why you thought that. There's a story about him. A friend of mine was doing a trip to Australia, and he happened to be behind him in the queue to check in for the hotel. And he told one of his staff, "Quick, go to the bar and order the drinks because happy hour is going to end in 10 minutes.
Well, you answered your own question, Stephen. George, I can't remember, it's a third or maybe even fourth generation. And generally, diligence doesn't travel that far down in a wealthy family. And he takes enormous responsibility for the value of this company and what it means for him and his broader family. And he's very thoughtful about the investments that he makes, and they're not all good. That right now, they're struggling with some of their, historical assets in the UK, some of which they've made significant investments in on the back of government policy. The government is changing the policy, and um, AB Foods is stuck, having to make a decision to potentially shut down some significant operations based on the way the government has changed the rules. And he's rational about that. And he has a long-term investing view. The business operates in several different fields, which is, generally difficult to operate in. And he does it well. And he's creative, and he's energetic, and he works really hard. And those are some pretty unique skills, in addition to being a little bit, I don't want to call him quirky, but he seriously understands, the value of a pound.
Yeah, well, I
And
think that's a good thing. But is that the sort of thing that you look for? And how do you, you know, obviously you've known him for some time, I assume. But when you're coming at something new, or where there's been a change of management, so we were talking earlier before we pressed the record button. I was asking you if you were interested in Kering. So Kering has got a new CEO, and if you said you said you didn't like certain aspects of that business, but if you were to judge, if you were to look at a business like that, how would you judge whether the new CEO was able to effect change and whether he was worth backing? Because in a way, once you've pressed the buy button, it's quite difficult for you to reverse that. So I just wondered if you talk us through how you think about it and what are the things that you look for.
Well, track record is the first one, Stephen. I mean, that's where we go first. And you look at, okay, who runs this business, who controls it, who runs it, what's the structure of the board, what are the incentives, and what has this person done historically, within that context or within another context. And that's your best evidence that this is the right person to be running the business.
But I mean, Kering's perhaps a bad example because he's come from a very difficult industry, the automotive industry. But what about if you've got a good track record in a different industry, but it's perhaps an easier. And no industry's easy; everything's got its own complexity. But if you're running an airport, it's a lot easier than running an airline. I mean, how do you judge how much of it is the man and how much of it's the organization?
Well, we don't know that an auto executive is going to be a successful luxury goods CEO. But what we do know is that business was originally, founded and built by industrialists, not by luxury good owners, right? And and so an industrialist hires an industrialist. It doesn't really surprise me. Um, uh, and I don't know if that's an error or not. It could be I'm comfortable with this person because he thinks about factories and efficiency, but I don't know that those are the skills that are necessary to be successful in the luxury goods business. It's more about quality of product, creating, value in the mind of the consumer. I think if you went for a walk with Brunello Cucinelli and then went for a walk with this fellow who used to run Renault, it's going to be a very different type of conversation, right? And Brunello he's brilliant. Very few executives. We're not shareholders. I would love to be an owner of his business, but he is one of the few people that is incredibly talented in terms of product design, product awareness, customer awareness, and understands how to run a business very, very well and think about the long term. That's very different than an auto, your average auto. And this fellow might be a very good, I don't know him. He might be a very good auto executive, but that's an experiment. And we don't want to be involved in an experiment like that.
Yeah, well, it's interesting. I'm doing a webinar for AlphaSense, who sponsored the podcast, on Wednesday with a luxury goods expert, just looking at it, and it is a very interesting case study. And obviously, it's the brands suffered very, very badly, and it's going to take, I think, quite some time to rebuild. So we can. I like these things. I'm not under pressure to invest, right? When you're a practitioner, you don't really have the luxury of observing something that, unless you can see an investment case for it within a reasonable time. But for me, I can look at
it might be informative, Stephen, to use Kering as an example, because it is, if you normalize the margins at Gucci, which is their big problem product, there's no question that the stock is cheap. There's no question, right? And as a result, the register is packed with value investors, right? There's no question that the acquisition track record of this company is not very good. There's no question. If you go back and you look at the last 5 or 6 deals, they look terrible, right? And there's no question that there's a lot of debt on the balance sheet, right? And there is no question that if they get those Gucci margins back up, that stock could be a rocket, right? It could be a rocket. It could do very well. And so why am I, as a value investor, sitting on the sidelines? Why aren't I involved? Well, we have 4 key criteria that we look for. We look for an undervalued security. Okay, check. We look for a good business. Inherently, this is a pretty good business. We look for a strong balance sheet. Does this company have a strong balance sheet? Not in the way that we think about balance sheets, no. And 4, we look for a good management team, and we just don't like the evidence is there that this company has historically not done very well, right? And it's still controlled by the same family, right? It doesn't mean that they won't fix it, but they just hired an auto executive. And so it doesn't fit the profile of the type of business that we're looking for. But we're not saying that, as a value investor, this might not fit boxes. The share register is loaded with value investors, right? But it's not the type of investment that we're interested in, right? We own Richemont, also another family-controlled company, but one and they've had issues with acquisitions in the past, but they run it with a big net cash position. Their jewelry businesses are far better and well curated than any other jewelry businesses in the world. The acquisitions that they make are small, and they're buying brands that can grow in the same way that they have grown Van Cleef and Arpels over the years. So you're spending a small amount of money on the prospect that you create over decades, much larger brands. So they're doing that now with another jewelry brand called Buccellati. And and you're not paying anything for that, right? And so we're in the same business, but we're in it in a very, very different way than most of my competitors are in it. And so that is we have these 4 key criteria, and that's where perhaps we might be differentiated. And Kering is a good example. Doesn't mean it won't work out. It doesn't mean my competitors won't be doing a victory lap a year or two from now. They could be, but it's not what we do. We do something that's different.
It's interesting. No, it's interesting. Thank you for explaining that. I just wanted to just touch on Artisan, because Artisan's not a very well known firm in this side of the pond. I mean, and I just wanted to sort of take you back to 20 odd years ago when you first started, because you'd been at Harris Associates, you'd mainly been an analyst, you hadn't been a portfolio manager for that long. What gave you the confidence to take on the role of running your own place? And what made Artisan confident enough to give you the trust? Because you didn't have the track record. And normally you would imagine that would be the first, you've been talking about how to judge management, you talk about track records, and it's even more so for a fund manager, right?
I meet a lot of people that say that they know what they're doing, right? And I was 37 years old. I've been an analyst for 10 years. I had a kid on the way, and I said to my wife, I got to see if I'm good at this, right? Because when you're an analyst, you can see the investments that you're making, but you're working for somebody, and somebody else is making the final decisions or influencing you. There are other analysts that you work with that influence you in many different ways. And so you don't really know until there's a collection of your own investment decisions. And so I needed to know. I had, I said to my wife, I have to leave, and I don't care if I'm working in the trust department of a bank, but I need to know that I'm good at this, because otherwise I need to, I would have become a marine biologist or something. And so Andy Ziegler, the founder of Artisan, who's no longer involved with the company, but I'm still very good friends with, he saw something, 10 years worth of experience. So when we had joined Harris, so we meaning we had a team of 4 analysts that worked for David Harrow, who I'm still very good friends with. We started to move this philosophy that I have of owning good businesses, came from a guy named Joel Stern, who was a management consultant who was an adjunct at Columbia Business School, and taught me, also listening to Buffett and Munger, it taught me, the wealth creation potential from owning superior businesses. And the strong balance sheet comes from Ben Graham. I mean, you don't have to be a genius. All you have to do is read his book, and he, if you're, it's another odd thing that's out there in the world. Sorry to sort of, get off base a little bit here, but, I always say to CEOs, why do you cede the most simple competitive advantage that you could possibly have? And they said, what's that? It's like a strong balance sheet. You're constantly, getting pushed into having this, notion of an efficient balance sheet, but that's garbage. Like, why not have superior financial strength and give yourself a competitive advantage, over other companies? So, we try to push that agenda. I'm sorry, Stephen, I've lost my train of thought. What was the question that I was answering? I lost my own train of thought.
Well, I just asked you why Artisan had backed you.
Artisan.
Had
Yes.
to back you.
So, Andy was an entrepreneur. They already had an international manager who's still with us, Mark Yockey, and he was fantastic. But they didn't have a product in a category that he thought was going to be very big, which was international value. And, the number of managers that were operating in what is a pretty well-defined niche was pretty small. And, after interviewing, sort of at my uh, I had sort of executed getting the other three team members. There were four analysts in front of Andy. He had turned them all down, and then I had a conversation with him, and he hired me. And I had no prospects on my own. I didn't have that much money. I didn't have a track record, as you mentioned. So Andy took a risk. I was the only manager that Artisan has ever hired that didn't have a track record. And now, between, this is kind of funny the way things work out, but between the 50 billion that I manage, and Artisan also has a global value product, which I started, was in my group, and now I spun it out to one of my co-managers who came with me from Harris. He manages a little over 30 billion. So that's 80 billion. We're half of the assets of Artisan. So why did I go there? I mean, Andy gave me a shot, and I wanted to see if I was any good at this before I got too old. The rest is kind of history at this point.
How does it work? I mean, you look after the investing, and they look after all the back office and the administration.
Yeah, I mean, if I owned the business 100%, it would be way better economically. But I don't know that it would be, what it is if I had owned it, because running the operations would be a fairly significant distraction. The way Andy set it up was brilliant. He hires managers, he puts them in an office, he gives them a directly linked incentive that aligns the manager's incentive with the clients, and leaves them alone and lets them operate. I go into the office. They're my people. They're my clients. It's my research. It feels like, when I generate the returns, because I'm investing right alongside my clients, I'm making money for myself along with my clients, and the business makes money, and I get paid off the business. And so the incentives are all aligned, and you have to focus on the long term, because you can try to jam investment returns in the short term. There are all sorts of tricks to do that sort of thing. But if it's the long term, there's a lot more value in a long term cash flow stream than there is in a short term cash flow stream. So,
No, absolutely. I just wondered why, it's obviously worked very well for you. I just wondered why it wasn't a more popular construct. You would think it would be quite an obvious thing. I mean, I've seen a number of people, mainly here in the UK, like starting hedge funds, and it's started by two people, and one person takes care of the operations, person takes care of the investing, and that removes a lot of the distraction. If you're trying to run a business and run a portfolio, it's a huge mammoth task, and it just seems to me a logical split. And I just wondered why there hadn't been more people following the Artisan example, because it seems like a good way of running a fund management firm.
well, I think generally speaking, it is, and other people have tried, and some have been successful. But I think we're an active management firm, and well, the vast majority of money is no longer going into active management. I mean, that's been going on for decades, and there's a lot of fee pressure. This is a tough business. If one of my kids said to me, "Hey, I'd love to manage money," I want to try to replicate what you've done, I would say, don't bother. It's the vast majority of retail wealth is invested in commoditized products at low fees, right? And that's where the business has gone. I don't think it's great. It's probably it's probably good if you're an average investor and you don't really know money managers, like buying an S&P 500 index fund, as Warren Buffett has pushed over the years, is perfectly fine. But if you're hiring a financial advisor whose job it is to give you good investments, and then they start shoving ETFs down your throat, why are you paying that person? I think it's just generally bad for the investing population, in the way that this industry has evolved. And it makes it tougher. And Artisan is reasonably successful, but it's not Fidelity or BlackRock or T. Rowe Price. It's it's a modest-sized asset management firm that hires a collection of boutique-ish money managers, who are trying to provide actively managed excess returns over a long period of time. Some are more successful than others.
So, having discouraged any young person listening from thinking about a job in asset management, I'm going to finish by asking my usual closing question, which is there a book or a practice? A book would be a nice thing that you recommend to a young person thinking about a career in asset management.
Well, I think building up the tools in your tool chest, are really important. In the basic tools, this is not going to surprise you. The basic tools that I usually talk about in terms of books would be, The Money Masters by John Train, right? So where you can learn about investing generally and the styles of different investors and how that's worked over time. Of course, as a value investor, I recommend The Intelligent Investor, where I think a lot of Benjamin Graham's principles still very much apply to the way that the stock market works and long-term investing. And then I think, some refinement in terms of the way to think about businesses over a long term comes in Phil Fisher's book, Common Stocks and Uncommon Profits, right? And so, there's no magic here. I think a lot of people probably talk about these books, especially value investors. But the one book that they don't talk about, which has been, and I mentioned it earlier, there's a book called Quest for Value that was written by Bennett Stewart. And Bennett was a management consultant. This is a textbook, so it's kind of a hard read. He was a management consultant along with Joel Stern, who was that adjunct professor that I talked about earlier. And in there, they're the folks who coined the phrase EVA, which stands for economic value add. And really what that gets at is, how much capital does a business have invested in it, and what's the return on that capital? How much value are they creating? And that's a really interesting way of learning the difference between a good business and a bad business. It is also a very interesting way to sort of create incentive schemes for people that are running businesses, and it helps you. It really is an insightful tool that helps you understand from a financial standpoint what is it that's really making this business tick. Where's the money going into the business? What types of returns are coming out? And how much does that money cost? Right? Because money's not free. So it's, I think if you put those four tools together, as an enterprising young investor, that'll get you pretty far.
So thank you so much, David. It's been a real pleasure talking to you. Thank you for being on the podcast.
Thank you, Stephen.
Well, I bet after listening to that, a few company CEOs might be wondering why I didn't title this The Active Investor. I was fascinated listening to how Samra agitated for change at Danone. Here's some great catchphrases. One he didn't use is "good things happen to cheap stocks." And I shall be watching closely to see how he reallocates cash from some of his existing holdings, which he no longer regards as cheap. I always thought that running a fund of that size must be incredibly difficult, but I think Samra has cleverly turned this to his advantage. Having to be as close to 100% sure as possible before pulling the trigger on a new position, and having to be slow to exit positions and enter new ones. I hope you enjoyed this conversation as much as I did. David and I actually carried on for another 20 minutes after we stopped recording, and I wonder if I should occasionally make this podcast longer. Let me know what you think. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel, and why not visit our website behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.